Let's start with yields, Jim, because those are front and center for investors right now. And you argue, Jim, with each Fed cut, you actually expect to see this upward pressure to longer term rates. Walk us through that.
Sure, I think that's right. Thanks, Josh. Thanks, Julie, for having me on. You guys stole a little bit of my thunder, but that's exactly right. I mean, I think the facts on the ground are we have a relatively robust economy. We have fairly strong consumer base, strong corporate base, and we have the Fed adding stimulus. And at the same time that the second largest economy is finally starting to kind of roll out a bit of stimulus to their broader economic issues as well. So as the Fed is doing this, and we saw it last time, your 10-year chart is a great one. Look at that date. When we start seeing that inflection higher in the 10-year, that's when the Fed cut 50 basis points. So the market is really trying to balance out the idea of the Fed cutting really into a fairly robust economy, and what are some of the ramifications of that as it relates to inflation, as it relates to spurring additional animal spirits, and therefore as it relates to the shape of the yield curve between now and the next 12 months, which we think is going to be much steeper.
Now, Jim, the last time we talked to you, you pointed out that the market has really been overestimating the number and the timing of Fed cuts pretty regularly. I think we can say September, that wasn't the case because we got a bigger cut, right? But what do you think happens from here? There have been some people who've said, maybe we won't get any more cuts, right? Or maybe we just get 1 quarter point cut. Where are you?
Yeah, I think it's a great point. It's a good topic. So the market was pricing in around 200 plus Fed cuts. Really, after the Fed stepped in with their 50, I do agree that was a bit of a surprise in our mind, a bit of an overreach, a bit of a stretch towards perhaps a policy error. The market only took out about 75 cuts, so we're still looking at a good number of cuts over the next 12 months, and we are still taking the under on that. So we do believe the Fed is going to cut in November. I don't think there's any doubt about that. They need to save face at this point in time. They're not going to go out there with a 50 and then pause. I do think December is a little bit in question at this point, but if we were betting on it, we still expect 25 in November, 25 in December, which is going to, again, further steepen the curve with this combination of a bull and a bear steepener. Short ends should continue to follow Fed funds lower, but we do expect long ends to continue to drift higher as these inflationary pressures continue to rebound.
You know, Jim, I'm just looking at the screen and the red today, and I'm just wondering how much of this is you just have so much coming at you if you're an investor, right? I mean, on the calendar, in short order, we've got big tech earnings, I got a big jobs report, I got the election, I got the Fed. How much of this is just investors deciding, you know what, I don't want to jump in here ahead of all that?
Yeah, I think there's a lot of that going on for sure. There's also, we're perhaps starting to get a little bit of early kind of year-end window dressing going on. Look, this has been a stellar year. Some profit taking is certainly not out of the vision of a typical investor as we're getting into, to your point, an election cycle and what that may or may not mean for tax rates kind of going forward. So I think you're exactly right. There's tons of uncertainty out there. Investors are trying to kind of digest all of this. And look, the reality is this is the third down day in a row. This has been a long time since we've had 3 successive down days. I think the trajectory for risk assets is still higher, although we do agree that today's kind of broadening out of performance, meaning that we're going to see kind of leadership coming from other areas of the equity markets and not just the kind of highly concentrated tip of the spear. We think that will probably continue. And these kind of ups and downs, we're just going to have to get used to that for the foreseeable future as we price in what does it mean to stimulate in a growing economy, and what does it mean with this kind of counteracting force of rising rates. How much does the economy and how much does the market, how much are they able to take before they start to roll over?